Welcome back to the deep dive. Right now, if you are tracking the global chemical sector, well, the narrative is overwhelmingly about navigating chaos.
Yeah, it really is.
It's a period of punishing supply-side overcapacities and, frankly, intense margin pressure. But the real story isn't just surviving the quarter, right?
No, not at
Yeah.
all. It's how a company uses that stress, that pressure, to actually execute its big long-term strategic projects, the ones that define its future growth curve.
Exactly. And that's our challenge today. We've got the Q2 and H1 FY26 results package from Laxmi Organic Industries Ltd.
Right, so our mission really is to move past just the top-line figures and
Mhm.
dissect the strategic choices. You find them hidden within the board results, the investor presentation, and definitely in the earnings call commentary.
We need to understand how they're managing this immediate market adversity while at the same time pouring capital into next-generation manufacturing.
Hmm.
Okay, so we're slicing this deep dive into three critical themes for you. First, we need to understand a major capital reallocation decision that tells us exactly what management is prioritizing right now.
Yeah, that's a big one.
Second, we'll analyze the tough financial results. Specifically, we need to identify the three very granular reasons management cited for the profit hit.
Yeah, they were quite specific there.
And finally, we'll examine the crucial operational milestones achieved in their massive CapEx projects. We're talking Dahej and Lotte here.
Okay, so to start, let's maybe look at the bedrock, corporate stability and governance. You see that reflected in the board meeting decisions from October 29, 2025. Stability at the top is, well, it's vital when execution risk is this high.
Good point. The board approved the reappointment of Dr. Rajiv Vaidya as an independent director. It's for a second three-year term running through late November 2028. Now, why is this specific governance item noteworthy? I mean, standard procedure, isn't it? But what does his profile add?
Well, I think it speaks volumes about the kind of technical expertise they want to keep right at the highest level. Dr. Vaidya isn't just a standard board member. He brings really high-level technical depth.
Like what?
B.Tech from IIT Mumbai, a doctorate from the University of Southern Mississippi, and crucially, 3 decades of experience specifically in the chemicals industry.
Okay.
So his continuity provides stability, sure, but it also ensures that these complex technical manufacturing decisions are guided by deep domain knowledge. That's especially important as they execute these major capacity expansions.
Right. That continuity provides the backdrop for probably the most decisive strategic move of the quarter. The variation in how they're using their qualified institutional placement, or QIP, proceeds. This isn't just a counting shuffle. This feels like a strategic pivot.
Oh, absolutely.
Okay.
It is. The board approved reallocating approximately $345.86 million of unutilized QIP funds. Now, these funds were originally earmarked for the Mahapi Innovation Center.
The R&D hub, essentially.
Exactly. Their R&D and for
And they are pulling that capital out of future innovation infrastructure and pushing it toward where?
the Dahej project.
Yeah.
It's a classic strategic trade-off, really. They are moving capital directly from long-term, optionality-focused R&D infrastructure
Right.
to immediate scale-focused manufacturing capacity. You could almost look at it like management selling their future insurance policy, that new R&D center, to guarantee today's revenue stream, which is this locked-in capacity at Dahej.
Mm.
They've also formally revised the Dahej project utilization timeline, now targeting completion on or before June 30, 2026. And this whole prioritization, it requires shareholder approval via postal ballot, naturally.
Okay, so as a listener, that reallocation signals maximum confidence in the Dahej project's viability, yeah. They must believe the revenue from that scale-up will deliver a better, quicker return than building out their R&D capabilities right now.
That's the signal.
But does diverting funds from the Innovation Center signal maybe a slowdown or a delay in that crucial future product pipeline, the pipeline this company really relies on?
Well, that's the strategic risk, isn't it? The implication is they believe the current innovation funnel is robust enough. Or perhaps they figure they can achieve adequate R&D function using existing infrastructure for, say, the next 18 months.
Really?
But the pressing need right now, it's volume and scale, driven by high-margin, contracted products coming out of Dahej. In a stress market like this, execution and guaranteed volume, well, they trump future optionality almost every single time. It's a calculated decision to secure immediate market positioning.
That sets the stage perfectly for the financial reality check then. You can't really discuss these strategic pivots without acknowledging the tough market conditions management cited, those supply-side overcapacities, intense global cost optimization efforts, industry-wide restructuring.
And the consolidated Q2 FY26 numbers, they reflect that pressure acutely. Revenue dropped 9% year-on-year, landing at INR 6,997 million.
9%, okay.
Adjusted EBITDA saw a sharp 47% decline. And the net result, the consolidated PIT, dropped a significant 61%. It's resting at just INR 110 million. These are tough numbers. They clearly illustrate the squeeze on margins.
That 61% PIT drop is brutal. But, okay, here's where digging into the investor presentation becomes crucial. Because management didn't just wave their hands and blame the macro environment, did they?
No, they didn't.
They gave specific, almost controllable reasons for the profit hit, particularly in the specialty segment.
Exactly. They segmented the pain. The first broader issue affecting the essential segment, that was macroeconomic.
Yeah.
Extremely subdued spreads for their staple product, ethyl acetate. Can't do much about that directly.
Right, market price.
But the specialty segment, which saw that big 20% revenue decline, that was impacted by three distinct factors they laid out.
And those three factors are absolutely key to forecasting any H2 recovery, right? Especially since specialties is supposed to be the high-growth, high-margin driver for them.
Precisely. So factor one, they anticipated the phase-out of one specific agrochemical intermediate product. Management actually quantified this. They said this phase-out accounted for a significant 10% of the specialties revenue drop. So it's a structural change they were prepared for.
Okay, so 10% planned. Factor two.
Deferred deliveries to global customers. This is important that revenue didn't disappear. It just got pushed into the second half of FY26. This alone accounted for another 7% of the specialties revenue decline.
Ah, so timing.
Priming, yeah. And factor three was just general market price moderation, a broader, maybe lower impact issue compared to the first two.
Okay, hold on. So if 17%, that's 10 plus 7 of that 20% specialties revenue decline is due to a planned phase out, which they presumably have replacement products mapped for and deferred deliveries that are now scheduled. Management is essentially telling the market their recovery in H2 is pretty heavily scripted.
That seems to be the message.
But is management relying too heavily on H2 being perfect? I mean, what are the contingencies if those deferred deliveries get pushed out again, or if the replacement agrochemical intermediate doesn't ramp up as quickly as they hope?
That's the execution risk, right? It's inherent in their outlook. But they also provided another important piece of the puzzle. It links directly to risk mitigation, and it involves their internal capacity.
Okay.
They mentioned they are undergoing a scheduled turnaround at their Q2 site right now, literally as we speak, mid-November.
Yeah.
And this involves doubling capacity in that crucial space.
Doubling ketone, that's huge.
It is. And that mid-November restart is essential. So the success of the H2 recovery isn't just reliant on those deferred contracts landing. It's also reliant on the seamless, immediate ramp-up of this doubled ketone capacity right after the turnaround. You could say that's the third leg supporting their recovery plan.
Okay, that makes sense. That capacity ramp up alongside fulfilling those deferred orders provides the volume leverage they need. But the real cushion in these financials, despite that massive PP drop, it has to be the cash flow, right?
Absolutely. That's the positive steering metric here. Strong cash flow from operations in H1 FY26. They generated INR 1,528 million.
Wow, compared
to a loss of INR 127 million in the first half of FY25. That is a massive reversal.
Huge swing.
It shows they are managing working capital and controlling cash generation exceptionally well, which is vital right now. That cash flow, that's the engine block fueling this whole next phase of CapEx execution.
Okay, let's pivot now to that execution, starting with the Dahej project, which is, as we said, receiving those reallocated QIP funds. What concrete milestones did they announce there?
They hit a critical operational milestone around Diwali time, receiving the consent to operate, or CTO, from the Gujarat Pollution Control Board for Phase 1 of the synthetic organic chemicals manufacturing facility at Dahej. That's a huge regulatory hurdle cleared.
So if Phase 1 is officially operational, does that mean revenue is flowing? What kind of certainty comes with that operational status?
It's highly de-risked, actually. Management confirmed Phase 1 is already operational, already supplying customers. And this is critical. The majority capacity of Phase 1 is backed by a multi-year, long-term supply agreement with a key global customer.
Ah, locked in.
Locked in. That contract immediately validates the scale-up and provides a stable revenue foundation, especially during market volatility like this. And looking ahead, Phase 2 mechanical completion is targeted for Q4 FY26, which is exactly why they're aggressively pushing that QIP reallocation to finish that expansion on time.
Okay, the customer lock-in definitely de-risks phase one, but
Yeah.
any sense if that's a high-margin contract? Or were they maybe forced to accept a slightly lower margin just to guarantee volume during this industry downturn? It's a buyer's market after all.
Yeah, the specifics aren't disclosed, obviously, but securing a multi-year agreement for the majority of capacity in this kind of market, it suggests the priority was definitely high volume and long-term stability over, say, maximizing immediate spot market profit. It transforms Dahej from a future potential liability into a near-term revenue-generating asset.
Got it. Okay, let's switch gears and look at the other major growth vertical, the high-tech fluorination business. This is at the Lote facility, the one that came through the Matani acquisition, right? What's the status of the ramp-up there?
The fluorine intermediates operations, they seem to be on track. They expect to deliver revenues closer to 40–50% of the peak capacity in this fiscal year, FY26.
And what's peak capacity estimate?
Peak capacity revenue is estimated around INR 200 crores. So they're targeting approximately INR 80 crores this year from the fluorination setup. That's a pretty solid ramp-up schedule for a specialty segment like this.
Okay. But the big specialty news, and one that really connects their fluorination expertise to global sustainability mandates, was that contract they signed during the period.
Yes, the significant partnership confirmed with Hitachi Energy. Laxmi Organic is setting up dedicated production for an eco-efficient gas. It's used in Hitachi's SF6-free high-voltage switchgear portfolio, which they brand as EconiQ.
EconiQ. Okay, why is this gas strategic? Why does it represent high-value chemistry?
Well, historically, sulfur hexafluoride, SF6, has been used in high-voltage switchgear. But the problem is it's an extremely potent greenhouse gas, like really potent.
Right.
So global regulations and just general sustainability mandates are driving this massive transition away from SF6. Developing and producing this new eco-efficient gas, it puts Laxmi Organic right at the forefront of a high-value, environmentally driven market segment. This is premium chemistry driven by regulatory necessity.
Makes sense. What are the financial and operational parameters of that Hitachi contract? Do we know?
We do. It's a 60 metric ton capacity project. It has a dedicated capex of 75 crores. Now, management made sure to assure the market that this capex is fully accommodated within their existing INR 11,000 million plan.
So no new funding needed.
Right, it doesn't represent an increased capital strain. Mechanical completion is anticipated relatively quickly, too, by Q2 FY27. And they emphasize this capacity is currently focused on export markets, supporting Hitachi's global requirements. Yeah. Essentially, they're securing a long-term anchor client in this premium sustainability space.
Okay. So beyond the massive CapEx projects, the company also provided some crucial updates on operational excellence and sustainability certifications. Often these details get overlooked, but for a global supplier, they're really competitive necessities, aren't they?
Oh, absolutely. They highlighted two major achievements that reflect their quality control and market readiness. First, they achieved the Bureau of Indian Standards, or BIS, certification for key products like acetic anhydride and ethyl acetate.
Okay.
What's crucial here, and they noted this, is that they were the first in India to receive this certification for those specific products.
And what does being the first in India for BIS certification actually mean in terms of competitive advantage?
Well, it signals really strong quality control and immediate regulatory readiness. This is absolutely crucial if you want to secure large government-tendered contracts, for instance, or even just winning over global customers who often require specific compliance standards before they'll even consider signing long-term deals. It's a fundamental hurdle that maybe their competitors still have to clear.
Gotcha. And second, they also reinforced their sustainability commitments.
Yes, they successfully completed the ISCC Plus GHG recertification for Site 1. That shows a commitment to tracking and reducing greenhouse gas emissions. They also maintained their responsible care certification and polished a strong Together for Sustainability score of 87%.
87% is pretty high.
It is. And in a market where large global customers like the one they signed for Dahej Phase 1, for example, are increasingly prioritizing sustainable supply chains, these certifications are basically non-negotiable entry tickets. That 87% score, it's a competitive advantage that directly feeds into their ability to lock in those multi-year export contracts we talked about.
Okay, so let's try and bring this synthesis together then. The short-term profitability challenges are definitely real. You can't ignore a 61% P per E drop. But those challenges seem directly linked to specific, quantifiable market and product factors. You've got the subdued spreads, the planned 10% phase out, and that 7% deferred deliveries.
Precisely. And management is strategically mitigating those short-term factors by aggressively pushing volume. Daiichi Phase 1 is operational with capacity locked in. That high-tech Hitachi contract is secured.
Right.
And the strategic QIP reallocation just emphasizes their confidence in the manufacturing ramp-up, prioritizing Daiichi over the innovation center in the short term. It's about immediate scale and guaranteed customer contracts right now.
So what does this all mean for you, the shareholder, tracking this company through a global downturn?
Well, I think it means the story is shifting. It's moving away from just survival towards execution risk. They've used strong cash flow to kind of bridge that profitability gap. And they've clearly defined the three pathways for recovery in H2 and FY27. Fulfilling those deferred orders, ramping up the new replacement agro-intermediate, and crucially, immediately hitting maximum utilization at the new ketone diketene capacity in Daiichi Phase 1.
That leads directly to our final provocative thought for you. We know that the specialty segment was hit hard in Q2. We also know they are doubling capacity in the ketone diketene space right now, scheduled to restart mid-November. So given that Q2 slump, how dependent is the speed and the magnitude of their overall recovery in H2 and looking into FY27 on two critical factors? First, the successful, absolutely seamless ramp-up of that doubled ketone diketene capacity immediately after the turnaround. And second, the successful Q4 FY26 mechanical completion of Daiichi Phase 2. It feels like these two specific projects really define the next 2 years of top-line growth potential.
Yeah, I think you're right. Those operational deadlines now hold pretty much all the weight of the company's profitability outlook. Monitoring the actual utilization rates coming out of those expansions and the contract realization. That's going to be the key metric to watch going forward.
A great forward-looking checklist for everyone tracking this story. Until next time.